fundsupermart.com.
Hi, the fund has a rather focused investment universe. Can you tell us more about its investment strategy and how it can complement an investor's portfolio?
Sure. The Asia Pacific Property Securities Fund is a balanced fund. It invests both in REITs and property developers. For REITs have the strength of having a strong, recurrent, consistent income. And for property developers, it's a more levered play into growth of a country or growth of the asset class. So it's a balanced approach insofar that the fund will invest in a portion of the fund will be invested in REITs, where the investor will receive a consistent dividend income. At the same time, if we do feel that there is opportunity in some markets, we will also invest in developers that will give you that kicker of a higher growth. And this growth is levered on, the income growth, the urbanization trend, the stronger economic performance of some of these other countries. How I think we differ from other property funds is that we have also customized the index of this fund to force ourselves to consider smaller countries like the ASEAN countries and the developing countries. The reason for this is we do feel, especially in the property developers, that the long-term growth potential is there, and we are going to see a multi-year, multi-cycle growth in some of these developing countries.
The fact that Asian properties have performed extraordinarily well has led to government-mandated cooling measures in places such as Hong Kong and Singapore. What is the impact of government policies on the sector, and what are the expectations for further cooling measures?
Sure. I think the cooling measures have meant that investment demand has been dampened. There are foreign purchase restrictions and much lower LTV requirements for buying investment-grade properties. Therefore, the volume transacted on the higher-end segment has been very low in Hong Kong and Singapore. But we don't see that impact in the owner-occupier market, and that's because the man in the street does have access to lower cost funding in mortgages to access the owner-occupied market. In Singapore, we feel that potentially the supply could be quite large because we are coming into a very strong sales cycle as well as a very strong construction cycle when the government is releasing a lot of land. So potentially you could see that aftermarkets could soften. Therefore, we are more cautious on Singapore developers. In the case of Hong Kong, yes, there has been policies that have dampened investment demand, but Hong Kong has also seen a very tight supply market and a strong need for new buyers to come into the market. There is a shortage of housing in Hong Kong. So I do think that there is a latent demand in Hong Kong. Share prices have underperformed the market in the last year, and we do think that there is opportunity to look at Hong Kong developers as investments.
Our research team has previously highlighted concerns over the Singapore REIT sector due to relatively expensive valuations and rising interest rates. What is your outlook for the Singapore REIT market, and can you tell us more about the fund's rather significant investments in Singapore?
Sure. The fund has quite a large REIT investment because the index has a large weighting in the REIT sector. But indeed, we are cautious on the interest rate cycle. It's no secret that interest rates are going up over the medium term. But at the same time, we are comfortable with the REITs in Singapore. For one, I do think that the balance sheet of REIT companies are quite light. They are not highly geared. Secondly, the income growth of Singapore REITs are moderate, as in they would likely grow in line with inflation. And thirdly, the valuations of REITs today are carrying a spread of between 2.5 to 3% against the 10-year government bond. So there is a very comfortable spread in the Singapore REIT sector relative to the 10-year funding cost. So I do think that we are in no way are we in stretched pricing territory for Singapore REITs.
How relevant are investments in property stocks and REITs in the environment of rising long-term yields, given that this may lead to higher capitalization rates, financing costs, and mortgage rates?
Sure, these are at the end of the day financing structured instruments that are dependent on interest rates, but these property companies at the same time will be looking for opportunities for growth as well. As I mentioned before, their gearing levels are quite low, and if indeed property prices do soften, REIT companies, for example, can go out and buy properties at a lower pricing to boost their income. At the same time, we look at the quality of property managers that manage these REIT companies. Often, despite the macro headwinds, properties can be managed well and generate growth that's higher than the average growth in the market. That's because properties can be enhanced, the tenants can be mixed around to, especially in retail property, to help the property income grow. We also think that the property assets as a whole, yes, they could potentially correct, but I don't think we're in a very sharp increase in interest rate cycle. There are still a lot of issues with the global economy. Singapore is still flushed with liquidity. I'm not so concerned that interest rates are going to rise dramatically over the medium term.